Hello, income investors. Welcome back to the Harvesting Income channel. This is all about how to make your income and grow your income. Today, I'm going to talk about harvest high income shares and two of their leading ETFs. And this is from the Harvest portfolios. The reason I'm going to cover this is because their two funds have been very popular. The HHIS that you see on the left, Harvest Diversified High Income Shares, and on the right you see the HHIH, Harvest High Income Equity Shares. Both have been very popular. We are not going to cover the Canadian one. Uh, so these are very popular because they cover the US stocks, blue chip ones, selected by the fund managers, and they also have the covered call writing and income opportunity, plus the ability to deliver long-term capital appreciation. So basically, we are doing HHIS versus the HHIH. So we're going to compare these two and see what are the differences. And I did one video on HHIS back in December end or January this year. So about 5 months ago. So at that time, this was a very new fund and reasonably new, and then we didn't have much data. But the fund was delivering very good returns, like around 25 or percent or higher. So, I was also invested in that fund. I also have some exposure to the HHIH that you see on the right side, which I picked up little recently, probably a few months ago. But HHIS I have been holding for some time, and it has been performing really well so far. But now let's look at why one should pick HHIS or why one should pick HHIH. That's the million-dollar question on how to make those decisions. Okay, before I go ahead, this video is only for entertainment and education purposes, not investment advice. Don't take anything here and make a decision to buy, sell, or invest. Do your own due diligence, consult with a professional. Okay, with that said, let's quickly go into the HHIS and HHIH. I'll explain both briefly. And then I'm going to compare the two at the end and show you the differences. While I'm looking at the HHIS, I'm going to just tell you only about that fund. And when I'm going to the second fund, I'll briefly touch upon the differences. Okay, HHIS is basically a diversified high income shares fund. It covers multi-sector portfolio, captures diversified selection of companies. The structure here is a fund of fund structure, which means that HHIS holds other harvest funds, which invest in different companies. So let's look at the holdings. Let me go to the portfolio breakdown. So I can quickly show you the holdings. Yeah, when you look at the breakdown, you can see that the holdings are basically other funds which focus on single stocks. So you have the AMD enhanced income, broadband enhanced income, Apple enhanced income, and so on and so forth. Like you have all these big seven companies plus other blue chip names which are listed on the NYSE or Nasdaq. So so basically there is a higher level of concentration on these AMD, Broadcom, Apple, Amazon, all these big names, and then it goes down as we move further towards Netflix, CrowdStrike, and so on. So you have roughly 20 companies in this list. Can the number can go up and down depending on the selection of stocks, and it captures the different types of industries, different types of companies across the board. So you have a diversified portfolio. Now let me quickly move up and show you the basic information. The ticker symbol is HHIS, and it is available on the TSX exchange. And it's basically composed of all these harvest single stock ETFs. According to them, the current yield is about 27.05. That is based on the this math. I will check this number if um, how much yield I am getting based on my reference number. Total distribution so far is $4.15. It's about 19 11.98 in terms of the price, and its currency unhedged. Management fee it says 0%, but for the underlying funds, they pay something like 0.40%, 40 basis points. So those are the basic features of the fund. The fund was started basically in January 2025. The point to note that is the distribution is actually monthly, but it can vary every month. Like it's not guaranteed. It can vary. It can go up or down. So far, from what I observed, it's pretty consistent. Sometimes it can go up a little bit. I don't know if it can go down. It all depends on the market conditions. Can go down. So that's the brief about the fund. This is about the HHIS, which is the high income shares, how is diversified high income shares. Now the next one will be different, but before that, I want to tell you some key points here. This fund employs a covered call strategy. That's number one. The covered call strategy is applied on about half of the holdings, up to half, up to 50% of the holdings can be, subject to this covered call program. And the second important point is the ETF employs modest leverage. As you can see on the screen, they employ 25% leverage, which can ensure higher scope for return and higher scope for monthly distributions. So that's about the fund. Let me look at it quickly if I missed anything here. Yeah, so that's about it. Like, so basically, the fund can go up to 50% in terms of writing the calls. Let me double check in the documents. I'll go to the ETF facts. Let me check the product sheet. Yeah, so the max write level is 50%, which means fund can write uh, up to 50% of the portfolio on covered calls. So which means the remaining part of the portfolio is available for full appreciation. So that's the key thing to keep in mind. So the good thing about the harvest funds is they have defined the max right at 50. They are not saying it will be exactly 50 or approximately 50. They are saying that it is going to vary. It could be 0 to 50%. I mean, theoretically, but it could vary and could be less than 50%. Probably they might reduce to 25%, 30%, depending on the market conditions. So that will mean that your upside cap is not going to get hit too often. So you have more room for the upside. So that explains the HHIS. Now let me move on to the next fund, HHIH. This fund is almost a similar portfolio like the HHIS. What is the difference? I'll explain the difference so we can, cut down some time on this. Because the design of the fund is exactly the same. But when you look at the portfolio, you have the actual companies or the actual underlying stocks that they hold. They don't hold the other ETFs, they hold the actual stocks. I like this for this reason because they actually hold the stocks instead of holding another ETF and that ETF again holds stocks, the complex fund of fund structure for HHIS, but this one holds the stocks. I like that part. The second part is this one doesn't have leverage and they can again go up to 50%. And you can see the ticker is HHIH and the fund holds single stocks. The NAV is 1158. Uh, Management fee is 0.4%. Again, exactly comparable to the HHIS. But I'll come to the fee part later on. There's something more to it. Uh, Inception is August 2025. So this was launched around 6 months later after the HHIS. And distribution is monthly and variable. And you have more or less the same kind of companies. The percentages can vary a bit, but it's same type of companies and same kind of strategy. Okay, so now let's look at the differences. Now we know how these funds work. Uh, Two things I like about HHIH, it does not have leverage, and HHIH holds the stocks directly. Those are the two key things which I like in HHIH. But overall, in terms of performance, both are like comparable. Like each one has its own pros and cons, and if you choose one over the other, you're not losing much. But the leveraged ETF may have a little bit of higher amount of risk. So if you're someone who's not comfortable with that, you can go with HHIH. Again, this is not a recommendation. Consult with your financial advisor. Okay, now that we have seen both funds, let me quickly take you through the comparison which I have made so that it saves us a lot of time and we can, understand it much better. Okay, I think that this is not visible on the screen. I'm making it slightly bigger so that we can go one by one. I will, okay, so HHIS is the leveraged fund or the lever, and HHIH is the unlevered fund. So the strategy wise, it's more or less same except for the leverage. Both have income and growth components, and both are doing 50, up to 50% coverage in terms of the calls. And the structure is different. HHIS holds like other funds, whereas HHIH holds the stocks directly. So we have covered this before. And inception January and August of 2025, respectively. Okay, this is where the difference comes, the fee uh, or the expense ratio. The fee point of view, there's not much of a change. Management fee is 0.4% for the underlying funds and zero point 0.4 in case of the unlevered one, HHIH. So HHIS does not charge a fee, but since the underlying funds are charging a fee, it is going to be exposed to that fee. So indirectly, it is being charged that fee. So the fee is almost like same, but the difference comes in the expense ratio. I'll tell you the reason why. The MER for HHIS is 1.85% and 0.99% for the unlevered version. There are two reasons for this. One is the leverage. That's the main thing that is causing the higher expense ratio. And the second, I'm not too sure if it has an impact. The structure in terms of fund of funds may have an impact, whereas HHIS hold the stock directly. Like there's not much of a um, you know um, management of different funds. You just hold the stocks directly in the account. So that can cause the difference between the two in terms of the expense ratio. And let me quickly go through if I have any other points from the management expense point of view. If I looked at the Harvest High Income Shares MERs, MER stands for the Management Expense Ratio. You can see here in this table, it's a very slightly bigger table, covers most of the funds they have. Here you can see that HHIH, they have a fee of 0.99%. Management fee is 0.40. So this is the unleveraged one. Whereas if you look at the leveraged fund, HHIS, it's about 1.85% for the management expense ratio. It says zero in the management fee, but technically it is subject to 0.40%. So I just wanted to show you because you can get all this information on the harvestportfolios.com website. So if you want more information on any of these or you want to double check something, always go to the fund website to get the latest information. Okay. So with that, like that's the difference in the fee. Like and if you have the price wise, it's 11.98 for the HHIS and 11.58. So when we look at the price and the monthly distribution, which comes next, we will get an idea of the expected yield. Now, distribution for HHIS has been between 0.25 to 0.27. So I'm because it for a few months it was 0.25, few months it was 26 cents, and then went up to 27 cents. So I'm expecting it's conservatively that it will be at 26 cents. So going by that number, the yield is going to be roughly around 26%, roughly uh, for the first year. The fund has completed 1 year. Like it's just an estimate that I have made here. Um, Going forward, like every year, it's roughly could be making 26%, or it could be pretty low, pretty high. We don't know. And again, this is just estimate, not the actual numbers can vary. So don't go by this and hope that every year it's going to give you the same amount of yield. Okay, now I looked at the HHIS unlevered one, and this unlevered one was giving about 18.5 cents every month. And since the launch, like August, it has been giving that much of yield. So again, here the expected yield works out to 19.2% based on this number. So uh, for HHIS, the leveraged one, it has already achieved this much because the fund has already completed 1 year. So we can say that this can sustain at least 20% yield, like roughly, like no guarantees here. But HHIS is going to be slightly less in terms of yield because it does not have the leverage here. So that can reduce the distribution yield and also influence the price or the capital appreciation part of the yield. So you're going to see this difference. But keep in mind that leverage also means that when the markets go down or go negative, these funds can go down all as well. So the leveraged fund on the left side, this can go down dramatically too if there is a bear market or if there is a sell-off. Whereas the unlevered one is going to fall little less. So, I mean, high risk, high return, low risk, low return, that kind of logic can be applied here. So if you are looking for a kind of a smoother ride or a moderate kind of return and sustainable one, probably HHIH is good. And but some people argue that the leverage one is good if you're investing for the long term. So yeah, I would leave that debate to you to choose whichever works for you. But I would say that both funds are, good if you're holding it for the long term, and provided you are investing in this as a core holding, because these funds cover almost the entire market because they hold the blue chip incomes which cover the major part of the market, and it can be held as a core fund. But you have more options available too. These are the two funds from house portfolios. You also have Hamilton funds, which are pretty good, HYLD and HDIV. I did some videos on that recently, and you can take a look at those videos and see which one suits you well, and take your pick. Like you can pick from one of these or one of those Hamilton funds. And the good thing is you need to be a bit more focused on the medium to long term. If you're holding for the medium to long term, you don't have to worry about the volatility and fluctuation in the yield or in the capital appreciation. In the medium to long term, you're going to do well. So that's the expectation. And yeah, so these funds are pretty good because you're getting pretty high amount of yield when the market does well. Right now, we are in all-time highs. That's the situation right now. But when the market turns, you may go down a little bit. You might go down to, probably 15% or something lower. Like, so that is something you need to be prepared for. So that's the risk part which I want to highlight here. So these are numbers as of now, and nothing is set in stone. It can change dramatically over time. So, but I'm just giving you the picture of these funds. These funds have recently completed one year, and one of them is going to complete a year. And I hope you like this video, and I hope you got value out of this. If yes, please subscribe to the channel and also hype it up. And if you have any comments, questions, or if you have any views about these funds, if you are holding one of these funds, please drop in your comments below or any questions you have. I would be happy to answer that. Thank you. Happy investing. Have a great day.